Okay, so let's get going. So first of all, thank you all for joining in today. I'm actually really pleased to see that so many of our existing users are on the call. What we have seen in our support calls is that there are an awful lot of clients these days who have rental properties, and they have intentions of converting them, for instance, to residences at some point, or in some cases, residences to rental properties. So we see this as a pretty important issue that faces clients, making very informed decisions around it all. So we're not going to cover all the possibilities today. We're going to focus on just on the conversion of residences or rentals to residences and the tax issues that are involved. So I'm going to show you today how you can provide accurate advice to clients. For those of you who are existing users, please feel free to follow up with Jeremy at any point if you'd like to look into this more. Also, we'll be posting today's webinar on our YouTube site later today. If any of you are looking at VisionWorks for the first time and want to learn more about it, you can connect with Paul Smith. He's the head of our sales and marketing department. Paul and Jeremy are both on today's call. So I know we've got a lot of existing users, but for the benefit of new users, I just want to take a couple of minutes and very briefly run through some basics about the software, just to kind of orient you to some of the features that we'll be using today when we look at this whole issue. So right now I'm on the About page. This is where we set up what we call the parties to the plan, Bill, Sue, Bill Jr. I want you to notice Bill's birth date, 1955, he's 59. Sue, 1958, she's 56. So they're starting to approach retirement. If we go down to the Entries tab, this is where you can create entries. And I just want to show you how that works. There are a couple of methods of doing this. One is that you can use buttons, so I can just drag and drop the cottage button onto the folder to create a cottage. You can also go up to the entry menu and open it up, and I could create a cottage using the entry menu as well. In this particular interface style, which we call the financial planning interface, because we also have a different interface style, life planning, you'll notice that as soon as you create the cottage, you can go in and start to populate all of the related entries. Who owns it, buy, sell, when was it bought, what did it cost, what's its current value. You can put in an appreciation rate, and I want you to notice that I can change that over time. So it's not a static rate. You might say, well, property values have gone up an awful lot. I don't expect much more appreciation in the next few years, and so on. If you come down to property taxes as an example, you can also put in entries, expenses related to the cottage. You've got two entry methods. I can go up to the table and I can type in a number, or I can actually drag these little dollar bill bundles around on the graph. So there are two styles of data entry. I'm going to delete the cottage for now. I just wanted to bring it up to show you, these panels, because we'll be using them when we look at rental properties. The other thing I want to do is just give you a quick orientation to output. And you can see down here three major output series: net worth, income assets, net cash flow. So if I bring up net worth, and we'll look at it for a couple, net worth, of course, includes all assets minus liabilities. So we're talking about houses, cottages, retirement plans, virtually anybody's assets minus their liabilities at any point in time. You'll notice we have an output series that we call income assets, and it is basically your assets less your thing. And by things we mean houses, cottages, cars, art collections. In other words, income assets are just the income-producing assets, such as TFSAs, RSPs, rental properties that we'll be talking about. And these are the assets you need to accumulate to maintain your income in your retirement years. You'll notice that there are two colors, and I just need to speak about this very briefly. The blue represents total income assets. The green represents what I'm going to call immediately liquid cash, kind of the cash in the bank that we can just access for our day-to-day spending. And the green is part of the total, but we need to show it separately. And the reason is we can have income-producing assets like rental properties that would make the blue look quite good. But that doesn't mean the rental properties are throwing off enough income for us to actually meet our spending needs. So it's possible to have the value of the assets look quite positive, but the cash in the bank to actually go negative. In other words, the income from rental properties is not enough to meet our needs, so in the model we would be spending more than is coming in, and the liquid cash would reflect that by going negative. So we need to see both parts of this to get an accurate picture. The third thing is net cash flow. Net cash flow is what comes in a year versus what goes out. And for all of these graphs, we start off with this overview, but then you can drill into lower levels of detail. And I want to show you this because we'll be doing this later. So if I go out to next year, for instance, 2015, drill in, we can see sources, we can see uses, and we can drill into each of these and see subgroups. So you can see the breakdown of expenses related to homes, lifestyle, personal property, pension plan contributions, debt payments. And again, you can go into lower levels of detail. You can look at any of these over time. And just to illustrate the lower levels, I'm going to drill into income taxes. And what we see being created in the background every year is a tax return. And if I scroll down, you can see things like non-refundable tax credits. We do this by province. And then we can just open up this list and go out to a tax return for any year in the future. And I needed to show you this because we'll be jumping to the tax return quite a bit today, having a look at how all of this works. So, in this file, I have created a rental property in Bill's name. You'll notice right now it's excluded. It's grayed out. So we actually have the ability to include and exclude entries from the output. And this accommodates clients who might say, well, we're thinking of doing something. What would the implications be? You can create the entry, but then you can turn around and exclude it and see the impact on output if it's not part of the plan. And so I intentionally excluded this so that we could see the income assets projection without the rental property being involved. And this, again, will show us the total income assets versus the liquid cash. If you go to total, you can see that. So I'll show you what happens. Once we include the rental property, then it's going to be part of the income assets projection. And as you'll see, total income assets are now, considerably higher. And I wanted to just review this again with you because when we make some changes, here we are with the total income assets now considerably higher because you've got the value of the rental property in there. So I wanted to show you this because when we make some changes today, we're going to see the impact on the income assets. So the first thing I want to do is have a look at the rental property inputs to see what's involved. So if we go to it, we're going to see ownership. We can see when they bought the rental property, and I have it as 2012, an existing rental property for a couple of years. This is pretty commonplace. And I put in a value of $500,000. If we go down to building land details, you'll notice we're showing the $500,000, but we have to break it out into what proportion is building and what proportion is land. And you'll notice these percentages, you can change that proportion. An 80-20 proportion is pretty commonplace. Now, the reason we need to know this, of course, is because what's involved with a rental property is a capital cost allowance claim every year. So we need to know what the starting value of the building was, what its current undepreciated capital cost is, and then actually quite separately, what value we're going to put on the building and on the land today. You'll see that we can put an appreciation rate factor on a building and on the land portion. So even though we have a rental property and we are depreciating it for tax purposes, it still can appreciate for overall market value purposes. And we've all experienced that over the last several years with rising real estate values. So there's a tax value, if you will, and then there's an actual market value. So you have the ability to accurately portray those numbers. And then in addition, other entries include things like, the gross rent, which I have in as $24,000 and so on. So those are all of the basic inputs. One other thing is the class of building, and it's the class that determines the rate of risk the building is depreciated. And generally, 4%, which is what we default to, would be the standard. Now, when it comes to all of these sort of rental property factors, all you need to do is click the Help button, and it provides how-to help for this specific panel, gives you a general overview, and then C also gives you the step-by-step instructions. And I wanted you to notice these jump topics, and if you click on them, they bring up all the rules and regulations. So they tell you what a Class 1 4% property is, for example. Or if we go down to UCC and bring it up, it explains how the capital cost allowance claim works. So for those of you who are existing users, I know that you're familiar with all of this, but I still needed to go through it for people who are looking at the software for the first time. Before I go any further, this is sort of very basic stuff about rental properties. Does anybody have any questions about anything we've just reviewed? Are we all good to carry on? Anybody want to give me some feedback? Greg, you're okay to carry on?
I'm good, Michael.
Okay, thanks. So, what I want to do next is I want to look at how rental income is actually handled. And this is very important. If we go to net cash, and again, this is why we looked at output, we can drill into cash sources, for example. We can see rental properties here as a cash source, and we can drill into the rental income, and we actually see a table. And this table is what's used to calculate the rental income, which is $24,000 a year. It's inflated, by the way. I'm using the 3% inflation assumption. And then notice that's what we're getting, what people are paying us in the way of rent. But then we get to subtract our property taxes, our operating expenses, actual expenses. So we end up with net rental income. This is what we actually get net as in our genes, so to speak. But notice this capital cost allowance claim. This is like a bookkeeping entry. It's not an actual charge, but what happens is the value of a rental property is notionally depreciated every year, in this case at 4%, and we get to claim that as a deduction against net rental income so that we end up having taxable rental income. So what this is saying is the actual rental income we are getting in after our direct expenses is $16,000, but the amount that we're being taxed on is only $2,400. So the $16,000 is what we get in our Gs. It's actually the cash flow we get, and then there's what the tax man is going to take now, or what the taxes are going to be based on. And this is critical because all of this capital cost allowance is something that's going to come back and haunt us if we convert or sell the rental property. So we want to make sure that this is accurately being done. One other thing that I just want to show you is that I'm going to create a mortgage, which is also commonplace. And I want you to notice that we don't go to some liability section in the software to create the rental property mortgage. Any financing entry that's directly linked to an asset, whether it's a house, a rental property, or whatever it might be, we actually create that liability attached to the thing itself. So I'm going to create a mortgage. And the reason we do this is because there are certain tax implications. So we need to relate that liability directly to the asset. So in this case, I'm just going to make it $250,000. And then I'm going to go back to our net cash flow, and we're going to have a look at what this does to the CPA claim. By the way, I've got a certain feature turned on today, which is just slowing down the processing a little, along with, of course, the webinar slows things down. So if we go back to our rental property, notice that we have our rental income. We still have our same direct expenses, but now we're deducting interest. And notice what that does to the capital cost allowance claim. It reduces it. And it reduces it to the point, not to the actual dollar amount of 4%, but to the point where taxable rental income becomes zero. In other words, CPA claim cannot cause negative taxable rental income. So there's a limitation, and the limitation will vary from year to year depending on all of these other factors that are involved. And this is quite important because the CPA claim really represents our future tax liability when we go and sell it or leave it by way of a will. So in order to illustrate all the tax issues we're going to talk about today, I'm actually going to get rid of our mortgage. Any questions so far about, all these kind of basics about rental properties and the tax implications of them? So before we go on, I'm going to do one last thing to orient you to the software. I'm just going to go to the solutions page. And you can look at this as your plan creation dashboard, if you will. You can see down below we have the ability to bring up output. Over here, we actually have the ability to create unlimited what-if scenarios all within the same file. And again, we're going to be doing this today, so I just wanted to point this out. And then you can do other things, apply different planning tactics, reallocate portfolios, look at estate output, which we'll be doing later, and of course, analyze insurance needs. So what we'll do is we'll create a new solution now. And in order to do that, it's very simple. All we need to do is click the copy button. None of the output is going to change. We're just making a 100% identical copy of it. And I'm going to call our new solution Convert Rental. So we just need to give it a name and then save it. And then what I'm going to do is I'm going to go to the Tactics tab, the Assets sub-tab, and I want you to notice these two tables. We have the ability to take secondary residences, convert them to principal residences by just putting in a conversion date, or take a principal residence, convert it back to a secondary residence, or convert to a secondary residence. You also have the ability to take a residence, convert it to a rental property, or a rental property back to a residence. And the direction of the conversion, so to speak, depends entirely on what the asset is now. So the asset is a rental property, so we know when we put in the conversion date that we're going to be converting it from a rental property back to a residence. So I'm just going to put in a conversion date. I'm going to make it when Bill retires, and I'm just going to make it mid-year of 2020. And I want to bring up our income assets, total income assets, because what happens is when we convert this from a rental property to a residence, what we see, of course, is that the value of our income assets drops. A rental property is an income asset, a residence is not. So obviously, by changing the nature of the asset, it's going to change our income assets projection. So what Bill and Sue have decided to do is come retirement, they're going to sell their large house. They don't have a need for it anymore. They're going to take this rental property that they have, a condo, let's say. They're going to convert it to their residence. Their intention is to do a lot of traveling. Condo as their residence is much more convenient for them. So there's one more thing we have to do here to get this picture looking right, and that's simply we need to go in and we need to sell that principal residence. You know, we're going to be selling it in order to top up our investment pot, so to speak. So I'm just going to go to that residence, go to the sell, give, donate panel, say I want to sell it, and I'm going to sell it June 2nd, 2020. We have to put in a date which is 1 day after we do the conversion. Sorry, I should be doing it 1 day before. You can't have two principal residences at the same time. So if you go back to income assets, you'll see once you've sold it, then obviously we have a whole lot of money in the pot, so lots to live off of. Now, after we've sold this, there's one other thing that we want to do now that we see this large pot of capital that we can use during our retirement years. What Bill and Sue want to do is they want to spend it. And so I'm going to just create for them vacations entry, and I'll just use the standard winter vacations entry. And I'm using this as a proxy for additional spending. So I'm not suggesting that, you know, everything is going to be spent on the vacation. Some might be spent on vacation, some might be used to help grandchildren. You know, there could be a variety of uses. So I'm just going to use this as a quick proxy for increased general spending. So I want to bring up the income assets output because I'm going to run this right up. And we're going to start it in 2020 when they retire. And then I'm just going to run it right up to an additional $30,000 a year. And I'll run that out in time. And the reason I'm just doing this is by way of illustration is that I want you to see what happens when we click the Save button. Then all that additional spending takes place, and it obviously is going to have an impact on the value of our income assets. So you can see the line represents the pre-change value of the asset. The area graph represents the post-change value. And if we go out here towards the end of the projection, you can see that they still have, you know, plenty of money, a few $100,000. The one nice thing I want to show you before we start looking at the tax implications of this is that we also have the ability to properly model wills. So what we've got is the rental property is going to be converted into a residence. Bill owns the rental property. His beneficiary is Sue. And if we go to, and so if Bill dies before her, which is, you know, the life expectancy that we've got in here that Sue will outlast Bill, then we also need to know the beneficiary for Sue. In other words, the house will go from Bill to Sue and then ultimately to Bill Jr. So there's an aspect of this that I want to bring up. It's not just what are the tax implications, what are the retirement cash flow implications. The other aspect of this is what are the estate implications. So if we go to the estate tab, and we'll have to look at the estate output for Sue, because the residence is going to her, and then eventually Bill Jr. What we see is actually a shortfall in the estate projection. And if I click the Show Table button, it tells us that the liquid assets of the estate are down to not very much. There's still some money in registered plans for her, assets named in the will, the value of the residence. But we can see these taxes kicking in at death, along with estate administration taxes, probate fees. So not much in the way of liquid assets, less all these expenses tell us that we've actually got a negative residue. And we need to look at this because this is going to factor into, should we do this conversion? Shouldn't we do this conversion? What are the implications? So the implications are not just tax implications, the implications are also estate implications. So now that we've kind of got that picture, what we want to do is go back to entries, go back to net cash, and we're going to have a look at the cash flow projection for Bill in 2020. And just to refresh your memory, if you go to rental properties, when we sell the rental property, what ends up happening is that if we've been claiming capital cost allowance all along, then when we sell it, we have a CCA recapture and we have a CCA capital gain. That's the value to which the building may have increased in value over its original cost. And then in addition to that, we can have actually a capital gain on the land portion of the building. So when we converted it in 2020, because we've been claiming a capital cost allowance all along, we have an immediate tax impact, which is actually quite substantial. And if we want to have a closer look at that, we can go back and look at the income tax implications. This is again why we needed to navigate, see how we could bring up taxes. We can look at the income tax implications the year of conversion. So we see this large rental income amount because of the CTA recapture, and then we see a large taxable capital gain, CTA capital gain, and the capital gain on the land. So know this is a fair amount of fancy tax math. So does anybody have any question about this? Please speak up if you're not clear on it. Pretty straightforward. Everybody's okay? All right, so this situation, we've got a house, we've got a rental property, we're not going to need the big house. The intention is we'll sell the big house at retirement. All that cash comes into our investment portfolio, so it's going to help augment our retirement income. You know, our house is part of our retirement plan. And we're going to take that condo, convert it to a residence, and that's much more convenient because we want to do a lot of travel. So, and not an uncommon circumstance these days. And in doing so, because we've been claiming capital cost allowance, we end up having a CCA recapture and we end up having capital gain. And the reason, of course, people make these CCA claims is because it's that accounting charge against the actual income from the rental property. As we saw, we had $16,000 of rental income net after after property taxes and operating expenses, but our taxable rental income was only a couple of $1,000s. So we were getting a whole lot more money in our jeans because we're a whole lot more cash flow because we're making that CCA claim. So part of the attraction of the rental property. But if we choose to sell it at some point, then all of that CCA claim is going to come back. We're going to have to pay tax on it. So this is one of the issues in converting. Now what I want to do is I want to show you an alternative. And all I'm going to do is I'm going to copy our convert solution, what if scenario. But in this particular case, what I'm going to do is I'm going to go back to the rental property and I'm going to change it so that we don't make a CCA claim. We don't get that immediate tax advantage and that immediate higher cash flow. So I'm just going to call this one convert a CCA. I'm going to call it NA. We're not going to apply a CCA claim. So when I created this new solution, everything we did before in the last solution is carried over. The sale of the house is carried over. The additional lifestyle spending is carried over. You know, virtually all of that's the same. And then all I have to do to see the effect of not making a CCA claim is go back to the rental property, go to that building land details, and instead of claiming 4% a year, I just open the list, click net NA, meaning no, we're not going to claim it, and then click the save button. And then when we do, we get to see what the implication of that is. So remember, we're not getting more money in our pocket in enhanced cash flow because we're not making that CCA claim every year. But by the same token, when we do the conversion, we're not ending up paying a whole lot of tax on that past CCA. And when we look at this and roll our mouse over it, remember the solid area represents total income assets after the change, and the shaded area is total income assets before the change. And we can actually see in this case that by not making a CCA claim, even though we have more tax to pay in the short term, in the long term, we actually end up accumulating more. Any questions about that?
No, that's
so
it.
let's look at one more thing, and that's, we'll go back to our estate output. So you remember that when we looked at the estate output before, we actually saw that the estate was underwater, Sue's estate was underwater, about $160,000. Well, again, if we go back and we look at the estate and Sue's output, remember the residence is going from Bill to Sue to Bill Jr. So we look at Sue's output, what we see now is we have more liquid assets because we've actually retained more money, and we are actually, from an estate point of view, we're far better off. So the question is, why is it that this picture shows better overall wealth in the long term by not claiming CCA, and better estate output by not claiming CCA? Can anybody suggest to me what the reason for that might be? So here's how the law works. Let's go to 2020, and you'll remember before, when we looked at that rental income table, what we saw was a CCA recapture on conversion and also CCA capital gain. Well, what happens in this case is that if we don't claim CCA, we are subject only to a capital gain from the time that it was a rental property until the time we convert it. However, we don't have to pay the tax until we actually sell the rental property, or what is now the residence, or transfer it to a non-spouse by way of our will. So if we have a look at output pursue, what we see actually happens is that the capital gain on the rental property, even though we're converting it in 2020, it's not actually payable until Stu's death in 2040. So rather than claiming the CCA, paying that tax in 2020, having less in the pot to invest, what's happening is we're retaining everything in the pot. The pot is therefore growing at a much higher rate, and we're deferring the tax to later in life. And the tax is the tax that we would have paid in 2020 as a capital gains tax, which has got a preferred tax rate. And it's only the amount as if we had paid it in 2020. So it's, relative to $20-40, it's not all that much. So by not paying CCA, what we see is that we're far better off in the long term, and the estate is actually far better off, even though we make that conversion. So one last thing I want to show you is this. I believe that our role basically is not to tell clients what to do, but when they're thinking of doing certain things, our role is to help them understand what the implications are. So to the degree that we're showing them the implications, you could say we're giving advice, but really what we're doing is we're allowing them to thoroughly understand what all of this means so that they can make the most informed decision. So what we're able to do here is we're able to compare our convert rental solution where we're claiming CCA. We're able to compare it to our convert rental solution where we're not claiming CCA. And if we go out in time, we can see almost $500,000 of total income assets versus only $259,000 of total income assets, half the amount. What we did was we gave up the cash flow advantage in the short term. So if we go to net cash, we can most easily see this if we switch to the spreadsheet output, and we can see by converting our net cash flow is slightly higher in every year, but that's only happening from now till 2020. It's only happening for 6 years. So yes, in the very short term, we from a cash flow point of view, we'd be better off claiming CCA, but from a long-term point of view, we're better off not claiming it in these circumstances, and we're able to understand exactly what the tax implications are on conversion. If we claim CCA, we have to pay the tax man at the time we claim it. If we don't claim CCA, we have to pay only capital gain, and we defer those until we actually sell or transfer it by way of will. So those are the essential issues, and what we're able to show clients, not just current cash flow, but also the estate implications. So having seen all of this, now they're able to make a really informed decision. And their decision might be, well, we're going to convert, of course, but we're not going to claim CCA anymore. We see we're short-term cash flow not as well off, but long-term considerably better off if we don't do that. Questions?
Well, good.
Great.
So we wanted to review this, just as we did with our estate issues webinar a month ago, because we see these issues, the common, it's commonplace for people to have rental properties these days. It's commonplace for blended families. We have a 40% divorce rate, so we need to include wills in plans to understand the implications if assets are left to children from previous marriages. So the whole intention is to show you that these are very commonplace issues, and they need to be treated correctly for the clients to make the most informed decisions. If these issues aren't being treated correctly, people could make very poor decisions. You know, I'm claiming TCA. Hey, I get much more cash flow. This is great. I'm always going to claim CCA. And yet we see in the long term that in this particular example that that's not necessarily at all the right decision to make. So any other questions from anybody? Jeremy, Paul, do you have anything you'd like to comment on?
No, I'm good, Michael.
Yeah, very powerful, Michael.
Okay. So I want to thank you all for joining in, and if you have any questions and you're an existing user, as you said, please feel free to follow up with Jeremy. And if you're new to the software, then feel free to follow up with Paul. Either can be reached at 888-5. Let me put the phone numbers out right here. Easiest thing to do.
Well, Michael, I was going to also, Paul here, is also going to say that any of the Vision System clients have other common marketplace situations they're running into a lot. We're happy to hear about those as well, and we can, as we have more webinars coming down the road. So, feedback's really welcome.
Michael, it's Tracy here.
Yeah. Yeah.
Have you done much modeling for farming families?
Oh, are we off topic now, just talking about other things?
Oh, yeah. Well, I was just wondering if there was. I'm sorry. If
no, that's not. I don't mind at all, Tracy. Feel free to ask any question.
Yeah. If there is any sort of webinars or training.
Oh, I see.
That.
No. We have not done a webinar for farming families. I think that's a great idea. We're always looking for new ideas for our webinars. I think that's a great one.
Okay.
So in VisionWorks, you can properly model a farm. This is a self-employed income, which a farm could be jointly owned. And you can see here you can have equipment and so on, all of which gets depreciated. Farm buildings and land are exactly like a rental property. They have essentially the same components, depreciation, appreciation in the value of land, all that kind of thing.
Okay.
In CorpWorks, you would model a farm exactly the same way, so you can model an incorporated farm and then take the CorpWorks file to the VisionWorks file. And in VisionWorks, when we do will, we treat the transfer of assets to children and grandchildren correctly. In other words, no capital gains are applied.
Okay. Okay.
Yeah, go ahead.
I'll maybe call Paul or Jeremy just to go over some situations then.
Yeah, absolutely.
In the intro. Okay.
Yeah,
very
absolutely.
good. Thank you.
Yeah, we do farms absolutely correctly. Not just as self-employed, but also, corporately owned farms, and especially from the estate point of view, the tax issue.
Okay, very good. Thank you.
Yeah, my pleasure. Anybody else with any questions? Doesn't necessarily have to be about what we covered today, but just questions in general, or as Stacey, suggestions for things you might cover.
Yeah.
Okay, well, thank you again for joining in. As you can see up here, I've got our phone numbers up, Paul's extension. If you're looking at the software and you want to talk more about the software, Paul, and then for support if you're an existing user, Jeremy.
Thank you. Thank you.
Okay, thank you very much for joining in, and have a great day.
Thank you, Michael. Bye.
My pleasure.
Thank you.
My pleasure.